Have you ever wondered if an IUL really works? Well, we're going to get into that today. We're going to look at a policy that's been around for 12, 13 years now to see where it's at. What are the costs? Where's the policy at? What it's going to look like going forward? And what did the annual statement look like this past year? So stay tuned. Hi, my name is Aaron Andrew. I'm one of the co-authors with the IUL L.A.S.E.R fund book. And I wrote a lot of the details and numbers in a lot of the chapters of 6 through 10 of this one with my dad and my brother, Douglas Andrew and Aaron Andrew. And so what I'm going to get into today is show you a statement. I've been doing this for over 20 years now of helping people understand IUL, getting into the policies and seeing how they work and managing them through the years. So we're going to look at a policy today that's been around since 2012. So if we look here on the screen, as we get into this, we're going to see this policy has been around since February of 2012, and this reporting period is February of 2023 to February of 2024. So let's zoom in here and kind of see where we're at. So this is a client that's a female, age 54 when she started. So 54 years old when she started, preferred non-tobacco. And yeah, we meet every year, kind of see where the client's at, see what the policy looks like, how has it been performing. We'd like to see if we want to change the index accounts, like where is it invested, where we're at right now. So if we go down here and look at this, we're going to see what the policy looks like currently. All right, so right here, the accumulation value at the end of this reporting period, or before, a year ago, was $285,000. So $285,000 was the accumulation value of the policy last year in 2023. So what happened this past year? Well, we had about $2,000 come out in insurance cost, $90 of expense charge or administrative fee that goes on forever in the policy. And we'll talk about those in a second. And we earned about $22,000 of interest this past year with the different index accounts that she was in. So it's pretty simple math. The cool thing about Indexed Universal Life, or the L.A.S.E.R fund we call it, is everything's full disclosure. You see exactly what's going on in your policy as far as what are the fees, what are the returns I got, and what is the policy, what happened this past year. So basically, just so you know, this $2,000 is paying for a death benefit of $905,000, okay? So $905,000 is the death benefit on this policy. So if this person passed away, the family would get how much? Let's talk about this. So they have got $300,000 in there right now. This is kind of really nice, easy math. So let's just round that to $300,000 in cash value. Their death benefit is $900,000. Okay. So if they pass away today, does their family get the $300 and the $900, or just the $900,000? The answer is they get $900,000. And some of the critics will say, "Oh, that's a ripoff. They're keeping all your $300,000 and only giving you the death benefit of $900." Okay, no. What's happening is $300,000, because we chose what's called a level death benefit. I wanted this in this particular situation because I wanted my fees as low as possible. Sometimes it gets a little technical. This is what you will find out when you meet with us, whether we should do an increasing death benefit or level, option A or option B, and see what works for your situation, because it's different depending on how much you're putting in and how long for, okay? So $300,000 is part of the death benefit. That is your own money. So the client, this is really important, the client is not paying for $900,000 of insurance. The client is only paying for $600,000 of insurance. So the death benefit's $900, the cash value is $300, the difference is $600,000. Now, she was 54 when she bought this, all right? She is now, let's say, she's 64, 67, 68. She's about, she's about 66 probably right now. So about 66 years old. And the insurance cost, the charges for about that much death benefit, $600,000, is costing about $2,000, okay? You're gonna see with an in-force illustration, I talked to her about this, her and her husband, and I said, "Hey, what if we drop the death benefit?" So yeah, 67 now this year in the 13th year. So in the 13th year here, age 67, this is again what we call an in-force illustration. This is projecting forward what we can earn. So this is projecting a 6.3% return. Some years we're going to earn higher than that, some years lower. But in this example, if we earn $19,000 of interest this next year, our fees can be $500. Why not the $2,000 you saw a second ago? Because if we drop the death benefit down to $385,000, the difference between $318,000 and $385,000, that's the net amount at risk, we call it. So the corridor or the net amount at risk. $300,000 is your own money. $385,000 is the death benefit. So the difference is what you're being charged for insurance. So that's why it's only costing $500. Excuse me. A little more this year because there's a fee to drop the death benefit, like, $60 or $90, I think. But then look at the fees now. $300, $400, $444, $378, and then it starts to go up a little bit as you get older. Okay? But this is really cool to see kind of what it's going to look like going forward. The fees are very cheap. If you really analyze this and you say, well, at this point when we got $557,000 of cash value in the policy, okay, and the death benefit's $584, that's not much difference. But at that age, what age are they at that point? 76. Even though they're older, because it's a small amount of insurance risk, it's only costing us $378. And $90 of that is a set admin fee, an administrative fee we got to pay. So pretty cool. So, and we earned $33,000 of interest tax-free, okay, because it's inside the policy. Tax-free, no taxes on that. Just imagine if this was a other kind of financial vehicle where you got to pay taxes on the gains, okay? And if you had management fees, if you had a 1% management fee, you'd be paying about $5,000 in fees. All right, so $5,500, $5,500 in fees for a 1% management fee. Here, our fees are only $378. And we have that's paying for a little bit of insurance, which is nice. So if we die, our family gets a set of $557, they get $584. So it's paying for insurance. It's allowing the policy to grow tax-free because it's life insurance. That's the whole point. And you have zeros to hero. You don't lose when the market goes down. Not only that, you can borrow against this policy at 5% while your money stays in there. So you borrow against it. You didn't withdraw it. You can borrow at 5%, leaving your money in the policy, continuing to earn whatever it earns. And some of the returns in this account are the accounts that they're in. They have some accounts that show historically 10%. So we got 10%, 10%. Others down here we use, there's like 6.8, 5.6, 6.25, and so forth. Go up here, a few others. Up here at 5, 4.5, 5. So some of them don't show as high as the loan rates. This is where it's your choice when you take loans, and I'm going to show you an example with loans. So this client decides to take loans at a conservative example. You can see here they're taking $24,000 $24,000 or $2,000 a month tax-free. So that's the projection. Again, we don't know the future, but if we earn an average of 6.3, we borrow, we can take out $24,000 a year tax-free to age 100. Actually, this went to age 120. So it lasted to age 120, taking out $24,000 a year forever under these projections. If the returns are higher, like that 10% example, those accounts that were earning 10%, we could take out a lot more, of course, because this only ran at 6%. And this includes all the charges. You don't pay the loan interest. The loan interest just adds onto the loan balance. This is compounding at 5%. The cash value or the accumulation value is still growing at whatever it earns. And if we're earning 6 over here, borrowing at 5, we're making a spread of 1%, which doesn't seem like a lot, but it really helps out long term. Now, they could take what's called a fixed loan. If we take a fixed loan, this company charges 2%. You say, well, wow, 2% is a lot better than 5. We should do that one. Well, yeah, you borrow at 2, then the collateral, the cash value in the policy that is collateral for the loan doesn't earn those index returns anymore. It earns 2%. So you borrow at 2, you earn 2. It's called a zero-wash loan, or a zero-cost loan is what they call them a lot of times, or a fixed loan. So that kind of a loan would generate less income a little bit, but it would be more conservative, if that makes sense. And you can choose between these two loans. With most companies, they have these features. Not every one of them does. That's why it's important to work with, somebody that knows what they're doing. So in our firm, we help people, manage these through the years, look at the index accounts, which loan to take, and so forth. And because then also if and when to drop the death benefit, because you can't always drop it too soon. But in this example, the client decided to wait another year. So they decided to wait another year and say, well, let's maybe look at dropping it. Because once you drop the death benefit, it's permanent, okay? And if in the other example, let's go back to this one. So if we don't take money out of the policy and it just grows, the death benefit will actually grow. So you can see down here, the cash value is worth $1 million and the death benefit's $1,063,000. Once again, that little difference there of $50,000 about, that's how much insurance you're being charged for, not for $1 million. So that's why it's only costing us $2,000. $2,000 at age 86. So at age 86, the fees are only $2,000. I made $60,000 of interest tax-free. Okay, if you had a managed account, you'd pay taxes on the $60,000. You'd pay taxes on the gains. So maybe like 15 to 20,000 in taxes. Plus your management fees would be about, $10,000 on $1 million. Our fees are only $2,000, and that $2,000 gave us a little bit of insurance, but made it tax-free, gave us guarantees we can't lose, and gave us the borrowing ability to borrow, and you can also put it back. So super cool. So going back to the statement, let's just review what they earned. How did they earn that $22,000 of interest this past year? So in this policy, they had some money in this account that earned 5%. They had some money in this account, the S&P, that earned 9.5%, the cap at that point. They had some money in this NASDAQ account that earned 8.5%. And they had some money in a blended account that earned 7.74%. Okay. They had account, this one's much more aggressive, but some is hit and miss. That one, if they had money in that account, they could have earned 20% there. So you can kind of see they had it diversified. And when we met a while ago, we looked at it and said, hey, out of these different index accounts, which ones do we want to choose this year? What do we think the market's going to do this next year? No one knows, of course, but we can kind of make an educated guess and say, hey, this account down here has a 190% participation rate. That went up. The S&P account went up. This account also went up. So the insurance companies, the cool thing is, as interest rates have been going up, they've raised the earning potential on the policies. So as interest rates have gone up, they've been able to say, hey, we can afford to pay a higher cap now. So they've been slowly raising the caps now and the participation rates over the last few years, which has been really exciting. So in a nutshell, that's how IUL works and how this one has worked through the years and where we're at right now. If we want, the client can go from like 2,000 of charges and go down to like $300 in the next year if we want to drop the death benefit. If they want to keep it up there higher to have that death benefit for their family still, they can leave it up there higher. So that's kind of in a nutshell an IUL and how it works. So to understand this more, make sure you go to laserfund.com, get a free copy of our book, pay for the shipping and handling. We'll get you a free copy of the book. And a lot of these examples are in chapter 9 of the book. The indexing returns, the current ones, are shown in chapter 6. The tax laws are in chapter 7. And one of the tax laws changed 3 years ago that allow us to get away with even less insurance. So we have even smaller death benefit. So the fees are even more. So like this policy, if they bought it today, they'd have lower insurance and have less fees and expenses coming out. So that is a really cool feature that has lowered the fees by about 30 to 40% these last few years for our clients, which has been really cool. So anyways, thank you for watching, and make sure you tune in to the playlist, Does IUL Work? And you can see more videos like this. Thank you.